Hey, really quick before we get started, please remember to subscribe to this podcast wherever you listen to your podcasts. And feel free to check me out on my website, rhitch.com, for more information. Now, everything said in this episode is for informational purposes only and should not be relied upon as a basis for any investment or retirement planning decisions alone. All statements regarding companies made, if any are in this episode, I don't think any will be, but are strictly beliefs of myself and are my points of view and not a recommendation to buy, sell, or hold any securities. All right, so welcome back to the Financial Breakaway podcast, your clear path to retirement. Again, I'm Ryan Hitchcock, your host, and I'm a financial planner with High Point Capital Group out of Milwaukee, Wisconsin. Work with clients all over the country, and it's my goal in this podcast to empower individuals like you to make more confident decisions for a secure retirement. So in today's episode, I want to continue the conversation about healthcare in retirement. If you listen to my last episode, we talked a lot about, or I called it the 7 essential items you don't want to miss when you're planning for health insurance in retirement. And essentially what those were going through, Medicare. What is Medicare? When can you get Medicare? And essentially what are some high level costs of Medicare that you should start to look into, and some of the private insurances involved in that. Today, I want to talk about, an interesting topic that I get a lot is retiring early. So, Medicare starts at age 65. So what happens, or what should you do, is if you retire before 65, so before Medicare kicks on, what should you do for health insurance between those years? So if you retire at 60, Medicare doesn't turn on until age 65, what should you be looking at for health insurance during those gap years? And so first off, what you should look at is just what's called COBRA. And so COBRA insurance is just a continuation of your employer's healthcare plan. And that can go for up to 18 months. So everybody, this is a legal, mandate that people have an option to continue their health insurance plans from work through COBRA. Now, it might be more expensive because you're going to be paying the full premium yourself, where while you were working, your company might have been paying for some of that as well. So that's usually the first thing people look into. The second thing, people might look at just a straight up private insurance plan to maybe fill these gap years. And that's also an option. But where I think most people should look is they should look at the marketplace. So the federal marketplace insurance program. So this is a great option for people retiring at any asset level. And that's the confusing part, is people might be retiring literally as millionaires, and they should still be looking at the marketplace. And why that's confusing is the marketplace is an income-based type of health insurance program, meaning if you have low enough income, you can get some subsidies for your premiums. So let's dive into that a little bit. So these subsidies, they're known as what the government calls premium tax credits, and they're designed to help make the health insurance more affordable. But we're working in the system we have. And so it gets a little confusing, but in 2024 here, these subsidies are available to individuals and families with incomes between 100% and 400% of the federal poverty level. The higher up you go or into the federal poverty level percentage, you're not going to get as big of a premium offset or a subsidy. But if you're at close to the federal poverty level, you're going to get a bigger subsidy. So for example, let's see if I have one here. Let's say that you're a single individual. You have 400% of the federal poverty level, and that's about $58,000 in 2024. For a couple, that's about $78,000 of taxable income. So these figures, just keep in mind, can change year to year. But if you report incomes at close to these levels, your subsidy is going to be based off 100% of that or up to 400% of that number. So if you take 78,000 for a couple, and if you go up to 400% of that, that number can get pretty big actually. And so you still, the end kind of summary here is that you still might get a subsidy even if you have a pretty high income in retirement. So in a planning strategy, what you should be looking to do is reduce your taxable income as much as possible during these gap years. And so how you simply do that is by, having quote unquote income coming from places that aren't taxable. So that could be accounts like Roth IRAs or just cash. So you're still getting maybe an income in your mind and in your view of actually paying your monthly bills and what have you. But from the government's view, that's not taxable income. So the goal during these gap years is to really reduce this income by using money that is strategic from Roths and cash and other non-taxable income that you can fund your life, but still get really affordable premiums and pretty good health coverage through the marketplace. Planning for healthcare and retirement, it's obviously involves a mix of strategic and financial planning. You want to understand your insurance options, but if you focus on some of these elements and plan beforehand, you can figure out how to gap your health coverage until Medicare. Now, always consult with, me or other financial planners to talk you through this. And, thanks for joining me on the podcast today. And until next time, be well. High Point Capital Group is located at 1200 North Mayfair Road, Suite 300, Milwaukee, Wisconsin 53226. Phone number 414-253-4600. Securities and investment advisory services offered through Osaic Wealth, Inc., member FINRA, SIPC. Osaic Wealth is separately owned in other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth. Views expressed here should not be construed directly or indirectly as an offer to buy or sell any securities or services mentioned here. Investing is subject to risks, including loss of principal. Past performance is not a guarantee of future results. Indexes are unmanaged and investors are not able to invest directly into any index. Sector investing may involve a greater degree of risk than investments with broader diversification. However, there is no guarantee that a diversified portfolio alone will outperform a non-diversified portfolio in any given market environment. No investment strategy, such as asset allocation, can guarantee a profit or protect against loss in periods of declining values. Please note that individual situations can vary. Therefore, information should only be relied upon and coordinated with individual professional advice. Ryan Hitchcock believes the information presented here is accurate and was obtained from sources that are believed to be reliable. However, Ryan does not guarantee the accuracy or completeness of any information, and such information may be subject to change without notice from Ryan. Statements expressed by guests on this podcast are the views of those guests only and not of Ryan Hitchcock. Statements contained in this podcast may be statements of future expectations and other forward-looking statements that are based on Ryan Hitchcock's or guests' current views and assumptions and involve known and or unknown risks and uncertainties that could cause actual results, performance, or events to differ materially from those expressed or implied in such statements.